What I'm about to say is probably going to sound really bearish, and it really might be for the economy, for your job, for the price of your home, and so many other things. But stick around until the end of the video to find out how cryptocurrency might fare in the middle of a recession. Recently, we got the release of the Beige Book for January 2024, and this is basically just a summary of economic activity for 12 regions around the United States. For the past few years, the information in these summaries has been mostly about inflation being too high and people not being able to find enough employees to run their business. But recently, the data has started to shift, and this is a leading indicator because the Board of Governors of the Federal Reserve System puts this together, and they actually talk to business owners to see what the sentiment is and how businesses are operating. These business owners can actually tell what's going on in the economy before it actually shows up in the data. And it looks like these business owners are starting to see some cracks forming in the economy that haven't quite showed up in the numbers yet. According to the Federal Reserve Bank of Boston, economic activity did decline slightly on average, with manufacturers experiencing slightly weaker sales and residential real estate sales held steady at a very low level. Commercial real estate activity weakened further modestly, and the outlook in that sector remained mostly pessimistic. In New York, economic activity declined slightly during the latest reporting period, continuing a period of sustained weakness. Labor market conditions continued to cool, and employment growth slowed to a slight pace as demand for labor softened, with economic uncertainty inhibiting hiring plans. Manufacturing activity fell sharply, with notable declines in orders and shipments. Activity in the broad finance sector declined modestly, with ongoing weakening loan demand and rising delinquencies. There's a common trend here, which is that basically people are not ordering as much stuff because they don't have as much money. People are taking on a lot of debt, and businesses are starting to slow down hiring and maybe even start to lay people off. We'll get into layoffs here in just a moment as well. It continues to say the labor market conditions also cooled since the last report, and the availability of workers has improved. Contacts noted that the demand for workers has softened as economic uncertainty inhibited hiring plans. Many mid-sized companies have stopped hiring, while smaller companies have become more selective in who they hire. The Federal Reserve Bank of Philadelphia says that on balance, business activity in the 3rd District held steady during the holiday season, after declining steadily for most of 2023. It looks like in the places where business has held steady, it might have been held up by the holiday season, with people actually spending money to get presents and things like that. But now that the holiday season is over, that steady decline might continue, and that could have a significant impact on the hours that businesses are offering workers. It goes on to say manufacturers reported fewer workers and shorter hours. Low-income households spent less and yet paid more in credit, while affluent households continued to spend freely. Employment slowed, and manufacturing firms reported a slight decrease in employment and modest decline in average employee work week. As people continue to get less and less hours and they continue to cut the work week and even employees, that means that people are going to have less money to spend in the economy, and these businesses are going to continue to struggle more and more, having to lay off more people, causing a death loop, and this is called a deflationary spiral. This is basically what causes a recession, and that's going to cause the Fed to have to cut interest rates really drastically, because if they don't try to add stimulus to the economy, then it might actually fall off a cliff as people go into delinquencies and can't continue to pay the interest on all of the debt that they've been racking up over the past couple of years. Not to mention those high interest rates make it even harder for people to pay that debt, and really the only way to make the economy come back will be to cut interest rates. And not just 25 basis points at a time. Usually whenever they have to cut interest rates like that, they send them almost to zero. It says several contacts noted increased layoffs of mid-career professionals from finance, tech, and highly leveraged firms in other sectors. Staffing firms noted that businesses are becoming more selective when hiring. Many businesses overhired during the pandemic. You can see that this being more selective when hiring thing is starting to pop up more and more here. And with many businesses being overhired during the pandemic, they're going to have a lot of extra staff that they can get rid of to cut labor costs. In Cleveland, though, it looks like business has actually slightly increased in recent weeks, with contacts generally expecting business activity to increase slightly in months ahead. Well, that's not going to happen if a recession really starts to hit. Sales were strong for discounted items, though, and customers increased usage of buy now, pay later payment options, which means credit. And the discounted items being popular obviously means that people are struggling and can't afford what they really want. Employment was flat to slightly down during recent reporting periods. And as people continue to buy low ticket items and actually push off paying for them, this is going to hurt the bottom line for businesses, and this employment being flat to slightly down might get worse and worse as time goes on. In Richmond, too, it looks like the economic activity has expanded mildly, but manufacturing activity, trading volumes, and trucking volumes were slightly to modestly lower this period. Trucking volumes and manufacturing activity being down means that people are putting in less and less orders because people are buying less stuff. This is another one of those things that just adds to that death loop. And by the time all of this stuff actually starts to turn up in the data, we might be well into the recession. Manufacturing activity also slowed somewhat in the most recent reporting period. According to the Federal Reserve Bank of Atlanta, the economy grew slowly from mid-November through December, which also might have been pushed up by the holiday season, and labor markets continued to cool. Some employers slowed hiring. All of this slowing down of hiring and being selective and stuff is pretty rare actually during the holiday season, and that's whenever all of this reporting is from. So even though the economy did expand slowly from November through December because of the holiday season, them slowing down hiring in the face of that might be a sign that they expect a real slowdown to come in following months. In Chicago, they're expecting a small decline in demand over the next year, and there were further signs that the labor market is cooling. In St. Louis, economic activity has remained unchanged since the previous report, and in Minneapolis, the economy contracted slightly since the previous reporting period, declining demand and profits from the previous month. Construction and manufacturing fell. Brand new job postings fell notably in December. Firms reported being closer to fully staffed and being more selective in hiring, settling in with who they have and not hiring unless a candidate is perfect. In Kansas, economic activity declined moderately in recent weeks. Consumer spending fell across several categories. Contacts noted sales volumes at low-cost, quick-serve restaurants, or fast food basically, which had been robust despite pullbacks elsewhere, declined moderately in recent weeks. If even fast food is starting to take a hit, then this is probably a sign that the economy is actually really slowing down. Community organizations providing food assistance indicated the number of persons seeking aid rose significantly, particularly among working families and seniors. Use of seasonal employees was subdued at the end of last year, and businesses were reportedly much less likely to convert seasonal workers to full-time staff than in years past. Contracts reported a notable reduction in labor utilization, reflecting declines in worked hours, reducing hiring and temporary seasonal employees. Spending on other large ticket items like home appliances and retail furniture also fell. Kansas City might even be the worst of this whole list. And if people can't afford to get food and they have to go to food banks and stuff like that, even among working families and seniors, that means that they're probably going to be struggling to pay their house payments and their car payments as well. This is another one of those first signs that we're going to be hitting a real deep recession, is whenever the car market starts to take a hit, because that means that people are actually struggling to pay their car notes, and they have to make a decision between paying their mortgage payment or buying food and actually keeping their car. In Dallas, the economy expanded at a modest pace, but high labor costs remained a key concern for many businesses. That means that there's probably going to be some layoffs coming, because that's the only way to cut high labor costs. Business outlooks were neutral to pessimistic, with Contact citing weakening demand as their primary concern going forward. Many firms noted a mismatch between skills and experience they desire and those of the current candidates. Some firms noted that they were overstaffed, particularly in financial services and manufacturing, though very few were laying off workers yet. Contact said that he considered laying off but held off because he expects a rebound in business. And it looks like this might actually be a common theme, as people think that whenever the Fed actually lowers interest rates is going to bring the economy back. And it might, but we probably have to fall off of a cliff first before they get scared into lowering interest rates a significant amount. An urgent care center said that wages and salaries were at dangerously elevated levels that are not sustainable in the long term, Retail sales largely stabilized in December after a few months of decline. Again, retail sales stabilizing in December might have been because of the holiday season, but these few months of declines might continue after this because it usually does have a little bit of a drop off after the holiday season is over. Economic activity in San Francisco was overall stable during the reporting period, but demand for manufacturing products weakened and housing affordability issues and elevated demand for support services were observed. As you can see, it's really not looking good, and I think that all of this stuff is going to start showing up in the data pretty soon. As a matter of fact, we actually started to see it looks like today, as initial jobless claims came in at 214,000, which is 14,000 above the projected 200,000 and well above the previous 189,000. This is just a small uptick, but it can actually rise significantly and very quickly whenever things start moving, as you can see by the historical chart of the unemployment data. Usually unemployment will fall off pretty quickly and then level out a little bit, but whenever it starts to curve back up, you can see that it spikes pretty hard. And whenever we see that spike, we get one of these gray bars, which indicates that we're in a recession. It looks like we're starting to repeat that pattern right now, and unfortunately, if you zoom in here a little bit on the data, you can see that we are starting to see a slight uptick, and maybe we are going to start see this thing going parabolic into the beginning of this deep recession. I think we've been dipping in and out of a recession in certain sectors of the economy for some time now, but a real domino effect sending the whole thing into a free fall hasn't happened yet, and I think that's what's going to have to happen before the Fed drastically lowers interest rates and we can start bouncing back. The next Fed meeting is in 5 days at the time of recording, and it looks like we have a 97% chance that they're going to hold interest rates at the current level. But in March, it looks like it's about 50-50 if we're going to see a 25 basis point rate cut or if he's going to keep it at the same level. And if we start to see this economic data coming in more negatively in the coming months, this probability of a rate cut might start to increase. And whenever it happens, it might be more than that 25 basis points that we're currently expecting. Here we have the chart of the federal funds rate for the past few decades, and as you can see, it does slowly start to increase as the Fed ticks up those interest rates, but whenever we do go into a recession, they have to panic and drop interest rates drastically to stimulate the economy and pull us out of that free fall. This doesn't mean that they're going to go directly from a pause to dropping interest rates to zero, and we might see a couple of 25 basis point rate cuts before things get crazy. But eventually, as more people get laid off and things like banks and stuff might start to collapse, things are going to get really hairy and we're going to hear the Fed start to change their tune. And when that happens, they might drop interest rates back to zero, but we might have some pain still to come in the meantime. Right now, we've got the S&P 500 hitting an all-time high, but it is still within this rising, broadening wedge, and the volume is declining with a bearish divergence here on the RSI on the weekly chart. And if this thing makes a double top right here and doesn't actually blast off to really crazy all-time highs, nullifying this bearish divergence and breaking out of this pattern, then it might have a sharp decline over coming months as businesses continue to struggle and it starts to reflect in earnings report and everything else. I drive for Uber Eats as a side hustle, and I can tell you that business has really fell off of a cliff. It's almost non-existent recently, and it's actually fallen even more off of a cliff in the past couple of months. I thought it was bad before, but man, it's like people just have no money at all, and I'm not the only one. It's starting to reflect across all kinds of other industries. Just take a listen to this.
This is the cheapest that my prices have been in 3 years.
It's the return of seasonality, ladies and gentlemen.
I got 9 other creators from across the country, no, scratch that, from across the world to talk about what they're seeing in the car market and where they think it's going.
Car prices are going to continue to fall and repossessions are about to get out of control.
And it could go to the point where we can see a lot of people defaulting on their mortgages. We're already seeing this happen a lot with credit cards and with car loans, as you know.
And I'm not the only one that's seeing prices come down.
The price of those have absolutely tanked in the UK, some of them losing up to about half their value in 1 year.
What about F-150s, America's favorite vehicle? Not at a $72,000 MSRP.
This is going to be epic.
My roommate works at a grocery store, and even he says that business has fell off of a cliff. If people aren't even buying food, then people are definitely struggling. And like I said, this stuff can happen really fast, but it can take a while for the numbers to show up in the data. So really, the economy looks like it's already fell off of a cliff. But unemployment rates still probably have to rise drastically because the Fed does have a dual mandate. And their goal is to keep inflation around 2% and unemployment under 4%. Right now, we're at like 3.8% or something. And if it continues to rise from here, then they're going to have to take care of the other part of their dual mandate. And that does mean lowering interest rates. But in the meantime, I did say there's going to be pain, and that means people are probably going to be losing their jobs. Just in the past couple of weeks, we've gotten a lot of news of big companies starting to lay off employees. Here we have an article from Yahoo Finance that says Bank of America is threatening workers, saying they have 2 weeks to comply with return to the office plans. And this came just a few days after the news was broke of a surprise as Bank of America cut jobs 3 days before bonuses, ending the year down 5,000 people. Citigroup also decided that they're going to be slashing 20,000 jobs. Comerica has laid off 250 employees. Lloyds is going to cut 1,600 jobs. Amazon has just confirmed more layoffs, cutting 27,000 roles or 8% of its corporate workforce. Then we've got Unity cutting 1.8 thousand jobs, Wayfair 1.7 thousand, Google 1,000, Riot Games 530, Twitch 500 plus, Discord 170, Audible 100, YouTube 100 plus, TikTok 60. And if you just Google layoff, there's more and more being added to the list every couple of hours, actually. Here we have a new update that Microsoft is going to be laying off 1,900 people. And I think this is really just the beginning, and it's probably going to get a whole lot worse before it gets better. But what does that mean for the price of cryptocurrency? Well, I think Larry Fink of BlackRock said it best.
I believe it goes up if the world is more frightened, if people have fearful of geopolitical risk, they're fearful of their own risk. It's no different than what gold represented over thousands of years. It is a asset class that protects you. Right. And unlike gold, where we manufacture new gold, we're almost at the ceiling of the amount of Bitcoin that we created.
Rumor. I think the rally today is about a flight to quality, and I think there's more people running into a flight to quality, whether that is in treasuries, gold, or crypto, depending on how you think about it.
So let me know in the comments, do you guys think that Bitcoin and cryptocurrency are going to fare well even though the economy is about to fall off of a massive cliff? And do you think it is actually a flight to safety, or do you think it's going to trade like a risk asset and fall off the cliff with everything else? Either way, thank you guys so much for watching, and don't forget to hit that like and subscribe button. But most importantly, don't forget to have a wonderful day, and I'll see you next time. Bye.